Good afternoon, everyone. So I hope you enjoyed that last session. And now we have a session on pensions led by Dave Wilkinson, who is the NASUWT National Negotiating Officer, the union's pensions lead, and represents the NASUWT on the Teachers' Pension Scheme Advisory Boards in the UK. Just to reiterate from the other webinars as well that we've got the code of conduct, and so when putting questions or taking part in this webinar, if we could be respectful, and then if you could put also your questions into the Q&A and not into the chat, just it's easier to have those questions in the Q&A. And then we'll endeavour to answer as many questions as possible after Dave's talk, but if they're not answered, we will get an answer to you later on. Okay, and I will hand over to Dave.
Yeah, thanks a lot for that introduction. Thanks a lot, colleagues, for coming to this session. I'm just going to share a presentation. Hopefully it will do that for me. Let me do that. Excellent. Right. Could before I start, because I made a mistake at the last session by not asking this. Have we got anybody here? And welcome and many thanks for choosing this session. Have we got anybody here that's in the Scottish Teachers Pension Scheme or the Northern Ireland Teachers Pension Scheme? Basically, anybody teaching in Scotland or Northern Ireland. If we have, could you put that in the chat, please? Just say yes. And also, have we got anybody in an independent school here? Cheryl's saying yes, but in an independent school scheme. Okay, we have got
Northern Ireland.
Yeah, Northern Ireland. Yes. Okay. Now what I will say before I start actually is that even though this is written in the terms of the England and Wales Teachers Pension Scheme, the schemes are identical in Northern Ireland and Scotland. There are no differences in the schemes themselves, and I'll keep kind of feeding things in to do with Scotland and Northern Ireland just as we go through, but it's not actually referenced in the slides. So I just wanted to say that, and I'll also cover one or two things to do with independence, because again, this is a bit specific to England, but we are now starting to see some developments in Scotland, I'm afraid, which are concerning about independent schools and the Teachers Pension Scheme in Scotland. Right, so what I'm going to do now is I'm going to run through some of the key features of the Teachers Pension Scheme that we think as a union are really important, particularly in the current economic crisis, and I'll say a bit more about that, which is now showing no sign of abating, and actually is showing every sign of getting worse, tragically. We think are really, really important. I'm going to say something as well about the gender pensions gap, and the reasons as a union that we've identified as to why there is that gender pensions gap, and then hopefully this should take about half an hour. I'll try to keep it to that, and that should give us plenty of time for questions and discussion at the end. So just to start off, I'm going to start off with the England and Wales Teachers Pension Scheme. Very big pension scheme, second biggest pension scheme in the UK. It's got 2.1 million members, 721,000 serving teachers and lecturers. It's got assets of nearly £200 billion. The Scottish Teachers Pension Scheme is a kind of it's an identical scheme. It's obviously smaller because there's a small number of teachers in Scotland than there are in England and Wales, and likewise the Northern Ireland Teachers Pension Scheme is one of the smallest public service schemes in the UK because of the number of teachers in the North of Ireland, but the design of the schemes is exactly the same. So everything that I'm going to say about the England and Wales Teachers Pension Scheme applies to Scotland and Northern Ireland as well. One of the most important things that we can't stress enough as a union, and we need to be really, really proud of our scheme, is that it's a defined benefit scheme. It's it's my fault. I moved on to the next slide by mistake. It's a defined benefit scheme. That means that, talking about the England and Wales scheme, you can register with My Pension online. you can then predict with absolute certainty what your pension will be at the age at which you intend to retire, and you can plan for that. Now, it doesn't add inflation in, and anything that tried to add inflation in a few years ago would be absolutely drastically wrong now because of what's happened to inflation in the last 18 months in ways that nobody could ever predict. So it's in today's money levels, but you can see what, which I think is more helpful. You can see what your pension is at the age at which you retire. That's what defined benefit schemes do. They give absolute certainty over the level of benefits which you get. And we need to be really, really proud of that, because we are now in a significant minority of working people in this country in having a scheme like that. The vast majority of working people are in what's called a defined contribution scheme, where you put contributions in, they're invested, they're then valued at the point at which the pension is taken, and those savings can go up, they can go down, and I'll say a bit more about that later. And the high level of volatility now within those type of pension schemes, which we just do not suffer from that. We have a completely inflation-proof scheme. Just to say that there have been some independent schools leaving the scheme in the last few years, mainly in England and Wales, but starting now in Scotland. But it's still the case that half of independent schools, just under 50% of independent schools in England and Wales are in the teachers' pension scheme. Still the case. And they tend to be the larger ones. So actually, it's more than half of independent school teachers that are in the teachers' pension scheme. Just to say that in terms of our union's policy, we strongly believe that all teachers, irrespective of the setting that they teach in, so whether you are in an independent school, whether you are a supply teacher, you should have the right to be in the teachers' pension scheme. You should be enrolled in it. And if you want to leave it voluntarily, that's not a problem for us. I mean, we're not here to tell everybody to be in the teachers' pension scheme. We're here to say that we want all teachers to have access to it. And there are teachers who decide that they want to be in a different type of scheme for a particular reason, and all we would do is take regulated financial advice over that. It is deplorable that in England, particularly, so many supply teachers have no access to the teachers' pension scheme because of government policy. Government policy is that employment agencies, business agencies can't be in the teachers' pension scheme. In Scotland, in Northern Ireland, teachers are employed in the state-funded, by local authorities essentially, or in Northern Ireland, effectively by the department through the Northern Ireland Substitute Teacher Register, and they're all in the teachers' pension scheme. In Wales, increasingly more and more teachers are being directly employed by local authorities, supply teachers, I should say. All teachers on more permanent contracts are in the state-funded sector anyway, and they're all in the teachers' pension scheme if they are. In England, we know there's an enormous problem, and many supply teachers, agency teachers are excluded from the scheme. They are enrolled in a variety of defined contribution schemes, such as Nest, which the government has set up for employers as an auto-enrolment scheme if they've not got one of their own. And we know that is something that is at the forefront of our campaigning for equality for supply teachers, is pension provision. Just to show you this, actually, that I won't dwell on this, but the number of independent schools in the TPS has been falling since 2019, but it's stabilised recently. I just wanted to make that point, really, that it's not as though there's a mad rush to the door, really, in terms of exiting the scheme. It's still, as I said, the most popular pension scheme in the independent school sector for teachers. Now, I'm going to spend a little bit of time just outlining how the pension actually grows in the teachers' pension scheme, how it accrues. And what I'm going to do is to stress particularly the impacts of inflation. Because I'll be honest with you, when I started delivering this presentation, even 2 years ago, I wasn't spending a lot of time covering inflation. And actually, in 2015, when this scheme, the career average scheme, which all teachers are now in, when this was first opened, we actually had a negative inflation that year. It is absolutely incredible to think that was only 7-8 years ago, and we're now in a period of inflation which is comparable with the 1970s, and it shows no there's no sign that that's going to come to an end anytime soon. And unfortunately, tragically, that harrowing the harrowing events in Israel and now the wider regional war that started last Saturday, they are having an impact comparable to the war in the Ukraine. Before that, the pandemic, of just piling economic crisis, and in our country, actually, the Truss Quarteng government, short-lived Truss Quarteng government, which was economically illiterate and brought about an economic crisis to add to the economic crisis that we were already in, accelerated it. We have now cataclysmic shocks across the stock market and the government bond markets across the world, which are fueling inflation. Oil prices have started to rise again, gas prices have started to rise again, and it is incredibly important now to have a pension which is inflation proofed. And the only ones that are definitively inflation proof are defined benefits pensions, which guarantee to index against inflation. So what happens with the teacher's pension scheme is that your annual salary, let's say for the sake of argument, is 30k, and I know that's the starting annual salary for a teacher in England now, and I probably need to update this to make it a bit higher. But 30k, it's divided by 57, gives a £526 annual pension. So that's what you'd accrue in terms of your annual pension after you retire. You get paid that annually until you die. That's banked each year, and then it's increased. The pension pot is increased by CPI plus 1.6%. So this April, it's all of you that are in the career, in the teacher's pension scheme now, you're all in the career average scheme, and your pension pot was revalued by 11.7%. And that's against the background for many pension savers in this country, where their pension pots actually went down. Not only did they not keep pace with inflation, they actually went down because of the economic crisis and because of what's happening in the stock markets and the bond markets in particular. And private pension funds invest very heavily in government bonds. That is just an incredibly beneficial provision. And when this scheme was developed, I didn't really give a lot of thought to that, because to be honest, we'd had years and years of low inflation, relatively low inflation. We'd had increased inflation to around 5 or 6% after the stock market crash of 2008, but it went back down again. And I was paying my mortgage, merrily paying my mortgage off, when interest rates fell to 1%. I mean, nobody gave any thought to that we might be back where we were in the 1970s, which tragically we are. This just is a little kind of graphical representation of how it all works, really, how your pension accrues in value, and how it builds up. Now, one thing you'll notice though is if you're out of the pension scheme for more than 5 years, it only increases, the pension part only increases by inflation, not inflation plus 1.6%. Now, we regard that as a discriminatory provision because it impacts most detrimentally, or more detrimentally, on women. It's discrimination on grounds of sex, because women tend to take longer career breaks. They tend to have shorter periods of pension service anyway. I'll come on to that. I'm talking about the reasons for the gender pensions gap. And that's something which we're campaigning for an end of, to see an end of that. The reason we haven't is because it would cost money, and there would have to be some change to benefits, or employers would have to pay more in order to pay for it, and they don't want to pay more to pay for it. But also because the Westminster government, the Scottish government, and the administration in Northern Ireland all kind of subscribe to the view that the pension scheme should deliver better benefits to people that are in it than people who aren't. That if you're a serving teacher, what's known as an active member, that you get better benefits. It's a way of rewarding teachers. It's part of the reward system for teachers, encourages people to stay in the profession and encourages them to teach in the state-funded sector. Now, we keep pointing out to ministers again and again that people often leave pensionable service for matters that are completely outside their own control. You know, like for example, we get made redundant. There was a member that came to the session this morning who'd left pensionable service because she became a carer for a mum who was disabled, and so she became a supply teacher because it was the only way to manage that. And then she found herself cut adrift from the teachers' pension scheme. So people leave the teachers' pension scheme not voluntarily but involuntarily, and it's an unfair provision. This, and it's discriminatory. But that's it. That's how it is at the moment. Now we've put together some slides really just to stress the benefits of the teachers' pension scheme. What we think are really good reasons to be in it. One is the main one is it's a defined benefit scheme, as I said, where you can predict your income. It's always going to go up. It doesn't go down. And unfortunately, defined contribution schemes, the value of those can go down, and have been at certain points over the last 7 years. There have been certain points where they've fallen in value very considerably. I mean, a good example was at the start of the coronavirus pandemic, and we were meeting with TUC colleagues weekly, actually, to keep a close eye on what was going out there in terms of pensions. The impact of the lockdown actually led to a lot of private sector employers just pulling out of paying into pension schemes. That was an enormous problem. But most working people have their savings invested in DC pots, and there are some sectors where it's nearly all DC, so it's like retail. And what the unions that represented those sectors were telling us was that members were handing the notice in to retire, let's say in February 2020. The accrued pension wasn't very much anyway, a lot less than a teacher would tend to have. And then when it came to getting their pension, drawing their pension the following month, it was half what it had been the previous month, because that was the impact of the pandemic on wiping off the impact on the stock markets across the world. Essentially, at the start of the lockdown, it caused an enormous economic crisis and crash across world stock markets. Now, to a certain extent, that recovered, but then we had, again, the greatest tragedy of the war in the Ukraine is the loss of life. The greatest tragedy of the events in Israel and the wider regional war now in the Middle East is the dreadful suffering and loss of life there. Those are the greatest tragedies. But again, the impact is being felt, was felt again, the war in the Ukraine, and is now being felt since last Saturday in terms of pension funds across the world. And that's borne by savers. The impact of that is borne by the pension savers, not by anybody else, I'm afraid, in defined contribution pensions. We're completely immune from that. You know, like you, I'm a member of the scheme. I'm actually a pensioner member. I'm over 60 now, and we're immune from that. The other thing is that there's been a lot of publicity actually recently out there in the private pensions world, pensions industry, selling to women. And there's been lots of reasons given for that. And generally speaking, it's the gender pensions gap. And the gender pensions gap cuts across the whole of society and across all sectors. But another reason has been that because women have a longer life expectancy than men, then parts of the industry have been saying, well, you need to have a higher pension pot because you don't want it to run out. So various kind of figures have been bandied around. One that I've seen is that if men need to have a pension pot of 250,000, then women need to have a decent retirement, and women need to have a pension pot of around 300,000. Now remember, our pension is different to that. We don't have one big pension pot that we then take in different ways. You know, we have monthly pension income, and we can take a lump sum We have to do it if we've got final salary pension, but we can make it bigger, or we can commute part of the lump sum if it's a career average pension. So we don't just have a big pot in the same way as defined contributions to pensions do. But it can never be the case if women have, because women have higher life expectancy, that their pension's ever going to run out. Never, because it's payable for life. It doesn't matter how long you live. I mean, we got contacted by a member who was 97 fairly recently, who'd been getting, he was a widower as well, and he got a widower's pension and quite a significant back payment of tens of thousands of pounds because the rules had changed over that, and he was getting an additional, very large additional widower's pension, and he was concerned about the tax implications of that. So I mean, you know, however long you live, it's payable for life. That's what defined benefits pensions do. Defined contributions pensions as well. What Parliament has identified, the select committees have identified, that one of the reasons why pensions tend to be low in this country, in the UK, is because of charges, pension fund to the pension fund manager, fees have to be paid to them, and administration costs when the pension is taken up to be paid to the company that administers the fund. Now, in our pension, in England Wales scheme, Scottish scheme, Northern Ireland scheme, all the costs of administration are paid for by the employers, entirely by the employers. In the England and Wales scheme, it's 0.08%, paid for of pensionable pay, paid by employers, very, very low actually, very low figure, because it's got 2.1 million members in the scheme. It's a very, very low figure. There's economies of scale. We don't pay a penny towards our pension. So my pension online and getting benefit statements and all the calculators and everything else that we get. And when the pension is put into payment, and the implementation of the McLeod remedy, where you can have pension from 2015 to 22 swapped over into final salary scheme from the career average scheme, or vice versa, we don't pay for any of that. It's all paid for by employers. And of course, they pay 23.68% in the England and Wales scheme towards the pension. They pay 23% in Scotland towards the pension. It's going up next April, and that's all being funded by the Treasury. But if in the alternative scheme, the alternative defined contribution world, the minimum they have to pay is 3%. Teachers pay, and that's what's happening, I'm afraid, in some of the independent schools now that have left the TPS. They're reducing contributions down to that level. Employers can't unilaterally reduce the level of the contribution. They have to pay at a particular level to ensure that our benefits always increase by inflation. And I mean, one of the reasons that employer contributions are going up is because inflation's high. And if you appreciate that our contributions are fixed, if inflation's going up, then somebody's going to have to pay for that. And that's one of the reasons that employer contributions, not the only reason, but it's one of the reasons that employer contributions are going up. I've mentioned about inflation proofing, and I'm just going to quote here from a commentator in the Telegraph who wrote last year. This was during the Truss Kwarteng government, which was described by an investment banker who actually came to the TUC to talk to us about it. Who actually described them as economically illiterate. And, you know, the world stock market's lost faith in the ability of the UK government to manage the economy, and that caused what could have been, if it hadn't been for the intervention of the Bank of England, an economic crash. Could have caused a stock market crash as bad as 1929. Now that's not me speaking. That's the investment banker who came to talk to us at TC. This was, she wrote this commentator, Lauren Almeida, during that government. She said, retired public sector workers are to be handed their biggest pay rise in decades, while pensioners who worked in the private sector will see their real income eaten up by inflation. Public service pensions will rise by 10.1% next April, which they did do. She wrote this last October, so last April they did. It went up by in April this year by 10.1%. In line with inflation figures published last week, it comes as private company pension savings that offer no protection against inflation have been devalued by rocketing prices and struggling stock markets. Millions of savers who rely on defined contribution pensions, which invest your pot of savings over the course of your working life, are much more vulnerable to the double whammy of inflation and volatile stock markets, experts have warned. So basically, there's a double whammy there of inflation. So a DC pension may not keep pace with inflation, but it may actually fall in real terms anyway, because its value falls in real terms. It actually doesn't. It's not just that it doesn't keep in pace with inflation; it actually loses money in cash terms, and that's got worse, I'm afraid. Just when it looked as though things were starting to get a bit better, we had the events of last Saturday. For a couple of days before that, actually, we had a crisis in what's called the bond markets, because inflation was proving to stay high for a lot longer than governments had predicted and banks had predicted across the world, and they weren't delivering in terms of returns. And these are government bonds, and this is what pension funds tend to invest in. And again, the same commentator wrote a few days ago, a global rout in bond markets has unleashed chaos on British savers' pension pots, forcing thousands to choose between delaying retirement or crystallising huge losses in their lifetime savings. And they're putting it very, very kind of succinctly there, really. The choice for you then is, if you've got your savings in that type of pension, is you delay your retirement and hope your funds starts to recover, and gives you the pension you want, or you just put up with the loss. Now, our pension scheme is immune from that. It's completely immune from that. It's inflation proofed. Just to mention a few other things as well. I wanted to mention the death grant, the in-service death grant. Interestingly, that's 3 times annual salary for a teacher who dies in service. Interesting, the number of teachers who were opting out of the teachers' pension scheme, which is actually relatively low, fell enormously during the pandemic. And we think that might have been because people were worried that they might die as a result of having to teach. The schools reopened, obviously, during the pandemic, when many businesses were closed, and teachers were worried about the health impact of that. I'm pleased to say, actually, that deaths of serving teachers did not go up during the pandemic. It actually fell slightly. The deaths of pensioner members of the scheme, I'm afraid, rose enormously during the pandemic, because the impact was on older people, was greater on older people. But it shows that teachers do value that. And I just wanted to say to you how important it is as a scheme provision. It's very different to a life insurance policy. I know that some independent schools have brought in taken the teachers out of the TPS. They've brought in life insurance policies, and I'm just going to outline to you the differences. Apart from the fact that they have to be paid for, and that the money doesn't go into the teacher's pension pot, it pays the life insurance policy. We had a member in an independent school that left the teacher's pension scheme, and his school took out a policy to pay the 3 times salary death grant. So it seemed that they'd replaced that provision. However, unfortunately, this member had been diagnosed with cancer, and the company, life insurance company, said, "No, we're not covering you. You've got a pre-existing medical condition, and we can't cover you." Now, that's not the case in the teachers' pension scheme. There's no medical threshold for getting that policy, for the families benefiting from that policy, for the dependents or beneficiaries, because you can name anybody as a beneficiary for that. Actually, it doesn't have to be a family member. Automatically a spouse or civil partner, if somebody doesn't name anybody, but it doesn't have to be. And basically they wouldn't cover it. Now, the good news is that the members in this particular school took industrial action. They took strike action to get the school to go back into the teachers' pension scheme, which it did. And the member then became covered again by the 3 times annual salary death grant in the scheme. But it's a good reminder of the differences between life insurance and the scheme provisions. I will say as well that more valuable, actually, financially frequently, than the 3 times salary death grant is the widowers, civil partners, and non-adult children pensions. There's about 775,000 pensioners in the England and Wales Teachers Pension Scheme. Now, out of those, 75,000 are widows, civil partners, and non-adult children who have survived the teacher who's died and are getting a pension. Widows, civil partners paid for life. Non-adult children up to when they finish full-time education, and they're actually many cases more valuable. Just to let you know about the ill health provisions, and I've come across some schools that have left the scheme that have tried to bring some. Or they said, "Oh, we're bringing in a kind of sick pay scheme for teachers who are off sick, so you get, say, 6 months of additional pay if you're off sick." Well, ill health an ill health pension is for people who are too ill to teach again. So, and it's completely different. Again, it's payable for life. And it's weighted so that the more seriously you are, the higher it is. And also, the younger you are, the higher it is. So we had a member who, and because that's when you have the greatest need, I supported one of our caseworkers who was supporting a member who, very tragically, again, fairly early in the pandemic, she became disabled, and she was a dance teacher when she was in her mid-20s. And because she couldn't work again, she couldn't teach again, she got a pension that was enhanced by half her prospective service up to a normal pension age, which is 68. So she got over 20 years enhancement on the pension. She was only in her mid-20s, so it was an enormous kind of she got enormously more enhancement than actually the amount of pension she'd accrued. And that gives her certainty of income for the rest of her life. Now, hopefully she'll make her recovery. There'll be therapies and treatments which enable her to get better. She might be able to work again during that time. But if not, she's got that absolute certainty over a pension, which actually, taking inflation into account, could cost, run into 6 figures, run into millions, to be honest, during a lifetime. But the scheme can afford to do that because it's got £200 billion in it, £200 billion in the scheme itself. And very few teachers actually need that level of pension at a young age, because very few teachers, fortunately, become that ill. And that's what it's like. It's like a big shared social enterprise, is a public service pension scheme. It's completely different to an individual pension pot. Like a defined contribution scheme, just to say that there's quite a lot of you sometimes get quite a lot of publicity from independent schools about one or two schemes that are replacing the teachers' pension scheme for those schools that are leaving it. About, oh well, this is good because more than one school's got this scheme. You can move from one school to another. You don't have to pay a new set of additional charges for that, and your pension's all in the same pot. The teachers' pension scheme, you can move between all state-funded schools, sixth form colleges, further education colleges, post-92 universities, half the independent schools in England and Wales, still the vast majority of independent schools in Scotland, all independent schools in Northern Ireland. There's far fewer anyway, and they're all in the teachers' pension scheme. They're all in the teachers' pension scheme, and then you don't incur any charges, and you're building up all your pension in the same pot. I won't dwell on this point actually about the independent sector, because I've made it the point already, really, that the Independent School Bursars Association draws account to the fact, attention to the fact that the value of a DC scheme, there's charges on it, and the value of the pot can go down. The value of the pension pot can go down. It doesn't guarantee any specific pension level. Completely different to our pension. Just to let you know, and this is the same in Scotland and Northern Ireland, that there is an employer contribution increase coming next April. It is necessary to increase employer contributions in order to ensure that our pensions are fully inflation-proof to remain at that target level that the government has set, and that we have been able to predict during our careers. So, if we go onto my pension online, we're retiring in 20 years, and we see what our pension is going to be in 20 years. It's important. It is that. It's not lower. And therefore, the employer contribution is going to have to go up. It's being funded by the Treasury. A separate grant's being administered by the DfE called the Teachers' Pensions Employer Contribution Grant. That is being given to local authority maintained schools and academies. They're fully funded. Independent special schools that derive their income from local authority fees and music clubs are also getting funding via the DfE. And at the moment, we're in discussions with them about the methodology for that. Independent schools, they have to fund it themselves. We're prepared to take industrial action. We've had a large number of disputes already over this in order to defend teachers' pension scheme membership. And if you are in an independent school that does this, then please go. Is proposing to do this, then please contact the National Executive member. I was at a meeting of members this week actually. One school where we've now grown from 40 to 118 in the last 3 months on the basis 118 members in this school on the basis of a dispute in order to keep the school and the teachers' pension scheme. So, and congratulations to members for fighting that, because in many cases it's proven to be extremely successful. I'm not going to labour this particular point, but a pensions journal called European Pensions Net and has now actually said this twice, that last year was the worst year for pension investors since the 2008 economic crash. The largest fall in assets, there was the largest fall in the value of pension pots since that stock market crash in 2008. It remains to be seen how bad this year is going to be. It might even be worse. But we are living in these dreadful times at the moment, which have such an impact on the economy, the world economy, that they have that then it just transfers straight over into the impact on defined contribution pensions. Again, another reason why it's really important for us as a union to defend our own scheme, and keep it in place the way it is for teachers across the UK. Just to say that the employee contributions capped at an average of 9.6% can't rise, which is good, because if it weren't the case, then employer contributions have gone up quite a lot since 2015. I'm sure we'd be seeing ours going up. They are likely to increase, at least for some teachers, but marginally increase, because the Treasury hasn't received enough income over the last 5 years. It hasn't received that 9.6% of teachers' pensionable pay across the whole of the UK, not just in England and Wales, basically because teachers' salaries haven't risen by inflation and teachers have been falling down into lower bands of the contribution structure. And so there will be some adjustments made, but nevertheless, they won't be large increases. If you do see an increase in the contribution you pay, it's not going to be a very large one. It's going to be unnoticeable, effectively. Now, I just wanted to say something about the gender pensions gap. There's a gender pensions gap across the whole society, and in the case of the defined contribution world, it's often because women just have less money to put into pension savings than men do, and that's the fundamental reason for that. In teaching, as with other public service schemes, same for all defined benefit schemes really, the gender pensions gap is very closely related to the gender pay gap. There's two things that influence the gender pensions gap. It's pay, it's pensionable pay, and it's the length of pensionable service. So if women have less service than men, and they do generally tend to have less service than men, then that affects the amount of pension that they build up. And if they have lower pay than men, that affects the amount of pension as well that they build up, because the pay is based on the pension. Sorry, no, around the pension is based on the pay. So you can see here, actually, I know this stopped at 2015 because we didn't commission this research after 2016. So that's the reason for that. But it hasn't changed since. It markedly won't have changed since. The gender pay gap. You can see very graphically there. This is research that was done for us by Warwick University, and they did it taking the school workforce census data for the whole of England. So even though it doesn't include Wales, Scotland or Northern Ireland, there's no reason to believe that it will be any substantially different. And so you've got 460 to 70,000 teachers for each of these years. All their pay has been analysed by Warwick University, and they've given us there what the gender pay gap is, what it means. And what it means, and if you look at the axis on the left-hand side, that's the male pay is 1, and you can see that the only decade where women's teachers' pay stays at the level is comparable to male pay is when male teachers are in the 20s. So when they're in the 20s, it's about the same level. But as soon as women get into their 30s and move through their career, then compared to men, their pay starts to fall in value. Their pay levels start to fall, and actually, by the time they're in the 40s, you can see that they're down around 0.85% over those 5 years. 0.85% of male pay is women's pay. Now, there's a variety of reasons for that. The career progression reasons, the number of women in leadership, the difference between primary and secondary pay, because secondary teachers' pay is higher than primary teachers' pay on average, and even though our profession, as you appreciate, 75% female, it's a lot higher proportion, a higher percentage of female in the primary phase than it is in the secondary phase. And even when it comes to leadership, female leaders' pay is a lot less than male leaders' pay. In fact, gender pay gap is bigger in terms of leadership, group teachers. One of the reasons for that is in England, particularly, the highest paid teachers, even though they're not really teachers in many cases, are chief executives of academy trusts, but they're in the teachers' pension scheme. They're the chief executives of academy trusts, and chief executives do tend to be male. Overwhelmingly, they are male actually. Within that sector, the only phase where there isn't a gender pay gap is primary classroom teachers. Primary school leaders, there's a gender pay gap in favour of men, but primary classroom teachers, the pay is comparable between men and women. Every other category. So when you look at secondary classroom teachers, secondary leaders, there's that gender pay gap. Now that means that women are building up less pension because pension is based on pay. As well as that, women tend to have longer career breaks than men. So we've been able to see earlier that that means that if women are out for more than 5 years, either because they take a break to raise a family, or because for carer reasons, like the colleague who was here earlier today, they end up leaving the scheme for that particular reason, then their pension accrues at a lower level than if they continued in service. And women have less service, traditionally have had shorter service anyway. And in fact, up to 2016, it did mean that because the government increased the threshold for, I'll just move on to the next slide actually. The government increased the threshold for the full state pension in 2016. So all working people, if you were in what was called an opted out scheme, which meant you paid a lower national insurance contribution because you were in a public service pension scheme or some other defined benefit scheme, they increased the number of years national insurance contributions you had to pay in order to get the full state pension from 30 to 35 years. And that actually meant that quite a lot of our women members who would have been getting the full state pension because they'd done over 30 years paying that national insurance contribution. They didn't get it because they hadn't done 35, and they ended up getting a lower state pension. So it's not just a teacher's pension that can be impacted; it's the state pension as well. Now that's phasing out now, because since 2016 we've all been paying the same national insurance contribution. All working people have been paying the same national insurance contribution, and that all accrues to the high level state pension. But it's still unfair on those people who are detrimentally impacted by that. So, it's a combination of discrimination, because the 5-year disqualifying break is discriminatory. So that affects pension growth, indexation, revaluation of the pension pot. It's a combination of discrimination in pay, and its exclusion, particularly of supply teachers in England, from the teachers' pension scheme. Now, I can assure you, colleagues, that we're campaigning on all these issues, and that means not just talking to government, but talking to the Labour opposition and talking to shadow pensions and Treasury ministers about these issues, because the design of our scheme is controlled effectively by the Treasury. So it's not just talking to shadow education ministers, shadow pensions ministers, but it's talking to shadow Treasury ministers about these things. What it's part of the shopping basket of what we want Labour to do, assuming that Labour becomes the next UK government. And likewise, we talk to the political parties in the devolved governments as well, Scotland and Northern Ireland, about these things. In practical terms, though, it is the Treasury that makes the decisions, even though Scottish ministers are meant to have control of the Scottish teachers' pension scheme. They don't in reality. Just to finish off then, just to say, if you're concerned about your actual individual pension pot, your pension accrual, there are ways you can purchase additional pension or faster accrual in the teachers' pension scheme. These are all 3 pension schemes. Right, yeah. So you can purchase additional pension in a variety of ways. If you've got an email telling you that you've been rolled back into the final salary scheme from 2015 to 22 as part of the McLeod remedy, then that will include details of these flexibilities. And you need to contact the scheme administrator. So whether it's teachers' pensions for England and Wales, or the SPPA in Scotland, or the Department in Northern Ireland, and they will be able to give you information about it. Clearly, we can't give you advice on it, because that would be regulated financial advice. We're not a financial advisor. We don't recommend any specific pension products, whether it's a scheme flexibility or whether it's some other form of pension saving. All we do is advise our members, suggest to our members that we do take regulated financial advice. And obviously, we have a link with Wesleyan, who's a financial advisor, to provide that. And there's details of that on our website and also on Wesleyan's website. So I'll stop there.
So it's 1:25, which we've come to the end of our session. I just really want to thank you, Dave, for all that information. Every time I join your sessions, I learn something new about pensions, about my pension. It's been very helpful. And if there are any questions that didn't get answered, they will get answered. We'll get back to you and answer those. And also the information, the webinar and the slides will be in the app for you to access as well. So thank you very much.
That's okay. I hope you have an enjoyable rest of the conference, and thanks a lot, Candy, for sharing this.
Thank you.
Cheers then. Thanks.
Bye, everyone.
Bye.